Hey there, and welcome. We're going to do something really simple today. We're going to strip away all the complicated charts and all the confusing jargon around trading. Because every single move in the market, no matter how big or small, really just boils down to two basic actions. Let's jump right in.
So let's just imagine for a second. What if trading was as simple as buying and selling a bicycle? Seriously, we're going to use this simple idea to understand everything today, because the logic behind trading a bike is the exact same logic that powers the huge financial markets.
Okay, so at the very core of it all, a trade is just a deal. It's an exchange between two people. You have a buyer who thinks they're getting a good price, and you have a seller who's also happy with that price. Both sides agree because they both believe it's the right move for them. This one simple idea is the foundation for everything else.
All right, let's dive into the first, and probably most familiar move. We call it trading up, or in market terms, going long.
So what does going long actually mean? It's pretty straightforward, really. It just means you're buying something, anything, because you think its price is going to go up. You're basically betting on a price increase. This is the classic buy low, sell high that we've all heard about.
Okay, let's get back to our bicycle. Let's say you find a great bike and you buy it for 8,000 rupees. A few weeks go by, maybe they've gotten more popular, and now that same bike is selling for 8,800 rupees. So you decide to sell yours. It's that simple, right? You bought it, its value increased, and then you sold it.
Now here's the cool part. That exact same logic, it's precisely how financial markets work. Instead of a bicycle, maybe you go long on an index like the Nifty 50, which just tracks some of India's biggest companies. Let's say you get in at a level of 18,000. If the index then rises to 18,010, you can close your position, which is just a fancy way of saying you sell it. The principle is 100% identical.
So in that little market example we just did, that price jump meant a 10-point gain. In the markets, you'll hear people talk about points all the time. It's just their way of measuring how much the value changed.
But of course, things don't always go up, right? So what happens if the price goes down? Well, if you had gone long at 18,000 NEM and the market fell instead, that would result in a loss. And that right there is the fundamental risk of going long. You're counting on the price to rise.
Okay, you've got the buy low, sell high idea down. Now, let's look at the other side of the coin, trading down, or what traders call going short. Now, this one can feel a little weird at first, but don't worry, our bicycle analogy makes it super simple.
So, going short. This is how a trader can actually take advantage of a price that's falling. The whole idea is to sell something you don't actually own yet with the plan to buy it back later when it's cheaper. I know, it sounds a bit strange, but stick with me, it'll make perfect sense in a second.
All right, back to the bicycle. Imagine this. You talk to a friend and you agree to sell them a specific model of bicycle for 8,000 rupees, but you'll deliver it next week. Then, during the week, a big sale starts, and the price for that exact bike drops to 7,200. So what do? You just go to the store, buy one for 7,200, and then deliver it to your friend for the 8,000 rupees you already agreed on. See, you fulfilled your promise by selling high first and buying low second.
And just like before, the market version of this is exactly the same idea. You go short on the Nifty 50 at 18,000 because you think it's going to fall. If it does drop to 17,990, you close your position. You just pulled off a sell high, buy low strategy.
So check this out. The market dropped by 10 points, but for your short position, that's actually a 10-point gain. And this is a really key idea. It shows you that traders can find opportunities no matter which way the market is heading, up or down.
And you guessed it, just like with going long, there's a risk here too. What if you shorted at 18,000, but the market went up instead of down? Well, you'd have to buy it back at a higher price to close out your deal, and that would mean a loss.
Okay, so we've got our two basic moves down. Going long for rising prices and going short for falling prices. But where does all this action actually take place? Let's talk about the financial marketplace.
Think of it like any other marketplace, but instead of fruits, vegetables, or bicycles, people are trading what we call financial instruments. This can be anything from shares in a company, equity, to futures, options, or even commodities like gold and oil. And in India, this all happens on big, organized exchanges like the NSE and the BSE. They're like the central hub for all this buying and selling.
Whew, we've covered a lot of ground. So before we wrap up, let's just quickly recap the most important things to remember from all this.
First thing, and this is huge, trading isn't just about things going up. The market has two directions, up and down.
Second takeaway, when you believe a price is going to rise, the strategy is called going long. Simple as that. It's your classic buy low, hope to sell high. And finally, number 3. If you think a price is headed down, the strategy is going short. That's the one where you sell high first and aim to buy low later.
And that's really it. Understanding these two directions, up and down, is the absolute foundation of trading. Every single thing you see on a complex chart, every news headline, it all boils down to that simple choice. So, the question now is, are you ready to explore the next concept?